Hi, it's Aoife Devitt, and welcome to this week's Markets Happy Hour podcast. I'm recording this on Thursday evening, the 28th of May. It has been a very short week for many of us with the holiday at the beginning of the week. It's also been a very hot week, particularly in Europe, with London, among other cities, sweltering in a heat wave. I'm on a vacation week myself, so I'm trying my best to get the lighting as good as it gets, but this is the best we can do. So let's kick this off. Lots to talk about in markets despite the shortened week. I've called this week's podcast Don't Stop Me Now. That's a reference both to markets as well as to the pace of change and acceleration, with Ferrari just introducing its first electric vehicle, the Luce, here shown in blue. It did meet with some ridicule, but at least they are trying their best to capture the new zeitgeist of EVs and a bit of aversion towards the paying the high price of fuel at the pump. We have read statistically this week that 30%, up to 30% of new cars are EVs now, electric vehicles. And this suggests that the consumer is, despite some of the headwinds around this, is seeing the long-term benefit of these vehicles. So this one may have met with some ridicule. Apparently, it is more interesting on the inside than on the outside, but definitely speed and acceleration very much on our minds. As usual, we'll discuss inflation, interest rates, geopolitics, equity markets, and other asset classes. And starting a little bit in a different order this week, we'll look at how $1 trillion is the new black when it comes to equity market, individual market caps. We've seen three stocks pass the 1 trillion barrier in Asia this week. And we know, look, we've got a chart later to show that many stocks have surpassed this now in the US. We are really in a new era in terms of stock market valuations. There has been a heat wave across the board, both physically and metaphorically, as we look at how equity markets have charged ahead. When it comes to AI, there has been a flurry of activity from some unexpected sources, with a papal missive entering the chat and a reflection on the morality around AI, and actually Anthropic joining the Vatican in some of this discussion. We do have some interesting statistics on emerging market risk, having reflected in previous weeks that emerging markets as well as Europe seem to have borne the brunt of the current military actions and war in Iran, even though it is the US that is the chief protagonist there. So we'll also then discuss portfolio implications. Before kicking off, there is still nagging negative news on the inflation front. We know that the price measure has been, as used by the Fed, rising to a fresh multi-year high. That's the change in personal consumption expenditures price index. And this has been not only in the US, but we're seeing this across Europe. There has been the pressure of fuel as well as food. We've had many slides relating to that over recent weeks. But the fact that these pressures are now mounting seems to have made interest rate cuts receded as a reality. And the very fact that mortgage rates in the US are now reaching new highs, over 6%, is a suggestion that we're not going to see interest rate cuts there. And in fact, it will instead be interest rate rises. Staying on the inflation point, we know that the real pressure point has been wages. This has been an area that is obviously much more important for the lower end consumer. And we also know that when it comes to wage growth and the effect of the cost of labor, that has been a significant factor in influencing the ability of companies to maintain their margins. So this is an interesting chart for the Financial Times. We can see that CPI has, for the most part, flattened now. It was higher in the aftermath of 2022, hasn't risen significantly, but it has been more or less flat. We can look at nominal wages and real wages. Real wages have ticked downwards in the US, in the UK, Eurozone, more or less flat, been quite volatile in Germany, but ultimately have been coming down. So while nominal wages have been flat more or less across the board, although they did tick upwards in the UK, surprisingly, they seem to have now started to recede again. This is a critically important point, as this will relate directly to consumer sentiment. We know that in the US, consumer sentiment has been persistently low recently, and the UK, although it isn't measured as reliably, we also know there that there has been a general problem within the retail segment because consumers have been feeling the pinch, not only of higher prices, but also of higher rates as expressed in their more variable mortgages. So the European consumer its inertia really is a reflection of its low sentiment there. So now we know why the consumer is perhaps so depressed. We see here that wages have been falling short. Another interesting discussion point that was put out into the media this week was a comment by Mohamed El-Erian. He was suggesting that the policy put, such as the safety net, the desire of institutions to swoop in to avert a crisis, is no longer a sure thing. He suggested now that the capacity of policymakers to respond to shocks is down across the board. And there wasn't a particular amount of detail in this article, but I think it is an important suggestion here that whereas markets have definitely grown used to interventions by central banks, whether it's through dropping rates, swooping in as a buyer of last resort, as we saw in the UK, or generally acting with a lot of telegraphing in order to stave off market crisis, that is definitely something that investors have now been weaned on. This suggestion is that that flexibility is not there. The flexibility may not be there because events may have overtaken, in the sense that we do know that, particularly in the US, the transmission effect around monetary policy and the effect on the consumer has been much less pronounced in recent years, even though the Fed was trying to cool consumer activity through raising rates. It was less successful in doing so, primarily because many consumers already had locked in low mortgage rates and were not as exposed to higher interest rates. I think they also know that that works in reverse too, that when they drop rates, there isn't always that immediate injection of stimulus into the economy. There's also now the rising inflation point, and we also know that rising rates, we discussed this in our discussion in Sydney with the HESTA economist, that the mere effect of higher oil prices, higher gas prices can have the same impact as a 25 basis point rise in rates. So when prices are doing the tightening for the institution, this again robs them of some of their power to influence the economy through their policy. And equally, when inflation is as high as we've been showing here, has been mounting, that obviously takes away the ability of policymakers to cut rates as they may like. So there is an increasing point of view that the new Fed chairman has a much more constrained mandate than he may have originally thought, and that it may have been a poisoned chalice that was in effect handed to him. So I think this is an important point to bear at the back of the mind, as well as with other factors, that if there's no policy put, it might be much more difficult for markets to be essentially have that safety net and have some underlying support. Moving to equity markets now, clearly momentum has been the order of the day. We've spoken a lot about new equity market heights being reached, and this has been the case again with the S&P and NASDAQ reaching new heights over the course of the week. When it comes to momentum, it is clear that this goes hand in hand with the AI trade. Momentum as a factor has had its best run on record, and we can really see this in evidence when we look at the semiconductor stocks, in particular something like Micron, which has seen a staggering increase in its market cap and its share price performance over the course of simply of the week we've had here. So the course of the month has been pronounced, but the week has been very pronounced when it comes to Micron and other semiconductors. We've mentioned before that 1 trillion is the new black. So I think this chart is very telling just in terms of where we are and where we stand with some of the market caps in issue. What would be even more interesting would be to overlay this chart with the country market caps of, say, the UK, Taiwan, Singapore, all of which will be significantly smaller than any one of these mega market cap companies. But we can see here that in pink, this was the discussion around the two new joiners of the 1 trillion club, Micron and SK Hynix. We've also seen throughout Asia, TSMC be a factor, as well as Samsung Electronics. They now are the two other members of the $1 trillion club. Just to name a few others, Nvidia topping the table of 5.2 trillion, Alphabet 4.7, Apple 4.5, Microsoft 3 trillion, and Amazon close behind at 2.85. Then to compare, Meta is down the table at 1.5, Tesla 1.6, but still staggering returns. And interestingly, in terms of the time to which they have got to these very impressive market caps, has been much more short It took a long time to get to the first, say, 500 million in market cap, but to get from 500 million to 1 billion has been a lot shorter. And then for these to accelerate to 1 trillion has been significant. The importance of this move to the market cap is because, again, getting back to the concentration point, if markets are increasingly more concentrated, if one single stock can now dwarf whole country stock markets, what does that mean for the volatility that we are likely to expect in an equity portfolio? And how should an equity portfolio be constructed in order to give broad-based exposure? Clearly, with these large market caps and the concentration in, say, semiconductor companies or the infrastructure components of AI, there is tremendous concentration. Whereas there may be diversification by client, it cannot be said that some of these companies are actually conglomerates and have multiple strands of business units. So tremendous amount of concentration mounting, and the excitement in Asia, where we've seen the Korean stock market up over 100% at one point year to date, very much driven by these tech companies, very much something that we are watching in terms of the composition of emerging markets, and we'll talk about that later. Another interesting point around equity markets has been the demise of the dividend. And whereas dividends used to be seen as a core yield substitute essentially in equity markets, and certainly a reason to invest in equities for certain investors who needed an income, the dividend yield of the S&P has been steadily declining. It's now hovering just over between 1 and 1.25% as average. Clearly, the idea of investing in equities as an income substitute has diminished significantly. Some of this will have been distorted by the fact that the large tech stocks are generally not issuing dividends, with some exceptions, but the equities as an income source has been diminishing quite significantly. And this then translates into the equity risk premium. When we compare the S&P equity risk premium to that of bonds, we can see it has been diminishing significantly. Some of that is because the bond risk premium has been increasing as those bonds have sold off, particularly at the more high duration end of the spectrum. But the equity risk premium shrinking in this way suggests that investors are not being paid for the equity risk that they are taking. And even though we have discussed valuations at length in this podcast before, it is worth reflecting on where we are relative to history in terms of whether investors are being paid to take risk. Clearly, that has not been the case for some time, as the equity risk premium has been declining over the course of the last 5 years. The other reason for holding equities, of course, is this singular exposure to a growth story, and in particular, this tech story. It has been hard to find that exposure to growth elsewhere in the portfolio. So this has been supporting the sustained allocation to equities. But as we can see, that the risk premium has not been justifying that, perhaps. I wanted to bring into the fore two slides that were in the slide deck last week, just to reinforce the kind of numbers we are discussing here when we discuss the hyperscalers and CapEx. We know that the pressure has been on across the board, that just taking 5 hyperscalers here, Amazon, Alphabet, Meta, Microsoft, and Oracle, to invest in CapEx. We know that they are now expected to exceed 1 trillion in CapEx spend by 2027. And similarly, the second chart relating to Meta reflects the fact that the CapEx spend is now dramatically in excess of the people spend. And we know that there have been headcount cuts. 20% seems to be the magic number. If we look across many tech companies and the recent announcements that they've made, all of it is relating to a new world order in terms of AI. But what we can also see is that the savings made through these headcount cuts is really quite insignificant compared to the expenditure that is expected. And these numbers are critical when we think about some of the other questions that have been raised around AI just over the course of this particular week. And this is where morality has entered the chat here. It was quite extraordinary that the current Pope has been quite willing to speak out, whether it's on issues of war and peace or around socioeconomic injustice, and now comparing the AI threat to a biblical Tower of Babel, suggesting that there is a threat to humanity as artificial intelligence marches on. I think that this is an important piece of the conversation that needs now to be elevated, as there have been many discussions with not only the trade-off between AI and jobs. We've seen communities push back on data centers. We've seen education institutions pushback on the impact on education and as well as on children and on the learning, the whole process of learning. And I do believe that when we think about the ownership of data and the ownership of copyright, there is a significant moral question there in terms of which information are models accessing. So the fact that this has now been elevated into the discussion and that Anthropic, to take one name, has been joining this discussion, suggesting that some of the moral underpinnings, particularly in the interface with humans, more the consumer level than say the agents, the coders. This does seem to be yet one other reason to be skeptical of the AI trajectory, which has been, as we noted, very much a one-way street in terms of the consumer sentiment and the momentum. I didn't have time to put it in these slides, but just over the course of today, in the last few hours, we have seen that Anthropic is again pushing ahead of OpenAI in terms of its latest valuation. Its valuation of its pending IPO is now looking to be very close to 1 trillion. They've had a latest funding round. So we've spoken before about the arms race in terms of between the hyperscalers. Clearly, the race to the finish line with this set of IPOs, SpaceX, as well as Anthropic and OpenAI, is going to be a key feature of markets in the second half of this year. What will be interesting, though, is whether, just as momentum has been all-consuming as we race and stock prices race up, will momentum equally reverse in kind when some negative pushback like this around AI, around its usage. And there's also been a number of headlines this week around its productivity gains. There have been questions raised by the likes of Microsoft as well as Uber as to whether the productivity gains of all of this AI spend, as we noted before, close to 1 trillion by 2027, that's just next year, and whether these productivity gains have been borne out. So a very interesting time in terms of the AI trajectory, definitely a sensitive one. We're going to end on a discussion of emerging markets because clearly, as we looked at the table for $1 trillion stocks, emerging markets have had an extraordinary amount of attention over the past week, some blowout numbers by indices, and a suggestion that this is perhaps the end of American exceptionalism as the tech story has moved way beyond the US borders into Asia. I think an interesting chart of the week from Oxford Economics is showing the performance of MSCI emerging markets versus MSCI US if we strip out those $3 trillion stocks that were mentioned before, TSMC, Samsung, and SK Hynix. If we strip those stocks out, we have the red line in the chart at the left. The red line shows that emerging markets really have underperformed relative to the US MSCI. If we add those three stocks back in, they have outperformed. Now, of course, the US MSCI will also have had tech stocks of its own in there. So we should probably do an apples with apples comparison. But we can see that when we include all tech stocks, there has been a significant, I'd say, late incoming arrival of the Asian tech stocks in order to compare their performance to the US. Another interesting chart by the same firm, Oxford Economics, looks at the perceived macro risk in emerging markets and how this has changed in the aftermath of the Iran war breaking out. And there are three risks that they look at: GDP, inflation, and policy rate. And these move exactly in reverse, as you might expect. You can see that it has been an upward revision significantly in the case of inflation, a little bit more modest in the case of policy rate, upwards in terms of inflation increasing and the expectation for rates there to increase. There has been then, when it comes to GDP, a significant revision downwards. So clearly the Asian markets are more exposed to the Iran war than we might have thought. And this, despite the fact that there has been very strong performance on behalf of the $1 trillion stocks, clearly the emerging market macro situation has been deteriorating, and this will have affected other sectors such as consumers, etc. So this reason this is important for portfolio considerations is most investors will have had a broad-based global exposure, which will have included emerging markets. This will have been a drag until this year. It is significantly performing this year, as we can see with the tech stocks in there. Emerging markets performing well is obviously a good thing in terms of an overall equity market portfolio performing well, but there is a risk that the concentration in these tech stocks is now only spreading to emerging markets. And we will question, we spoke about the equity risk premium earlier. There is traditionally being a much higher risk premium in the case of emerging markets, and whether this risk premium is also eroding. Another point to bear in mind is that the dividends in emerging markets have traditionally been higher. There has been a greater emphasis on dividends in these markets over the years, and there are certain investors in these markets who invest specifically for the dividends. So having a dividend yield in emerging markets that is higher could be another reason for investing there. But overall, for investors, a consoling thing to see that a global exposure has started to pay out, but equally to be concerned about the risk in place there. So that is our comments for this week. It has been an extraordinary week in terms of the pace of equity market movement. Clearly, no sense of concern around the prevailing geopolitical climate. We've had some skirmishes, again, drone attacks, as well as a suggestion that there will be an extension of the current ceasefire. So oil has been falling in response to that. Equity markets have been rising. We've even seen government bonds rise as there has been perhaps a cooling of some of the most extreme tensions and perhaps a sense that there was no major political change on the cards, particularly, say, in the UK. So that has been a bit of a response there, a bit of a rally for bonds as well as equities. Again, the balanced portfolio not exactly providing ballast, but at least performing in the right direction right now. That is it for this week. We will be on the road again next week and look forward to coming to you then. Thank you for listening to the Markets Happy Hour podcast.